Welcome back, everyone, to this live session at Small Cap Investing Summit 2013. It's a real pleasure to have you here for a session with one of my favorite up-and-coming investors out there. He's going to share a great idea. We're going to have Oliver introduce Sahm, and then the floor will be his. Feel free to type in your questions at any time into the online interface, and we're going to compile the Q&A roster and follow his remarks with the Q&A session. With that, Oliver, go ahead, please.
Thanks, John, and welcome to all of you. This should be a great session. We have one of the best investors of the new generation here with us, Sahm Adrangi, the founder and portfolio manager of Kerrisdale Capital Management based in New York. Prior to founding Kerrisdale, Sahm, who's a Yale graduate, applied his trade at the distressed debt fund Longacre, worked in the bankruptcy restructuring group at Shannon Capital, as well as the leveraged finance group at Deutsche Bank. As most of you will know, Sahm proved his investing mettle in the Chinese reverse merger fraud trade, exposing many of the U.S.-listed Chinese companies, and is a short seller delivering great returns to Kerrisdale clients. Sahm is not only a great short seller, though, he's also a big fan of Warren Buffett and likes to invest for the long term in undervalued businesses. So he's got a long idea for us today. I believe it's one of his largest positions. So without further ado, Sahm, the floor is yours.
Great. Thanks a lot for the intro, Oliver. I've got Navi Gihar here, who's our analyst who is behind the U-Haul idea. So I'm going to turn the volume down to take away the echo. So just chat me with any updates. There we go. So we're presenting on U-Haul this morning. We'll try to talk about it for about maybe 15, 20 minutes, and then open it up to questions. U-Haul is our second largest position currently, and we think it is a classic value investment. It's underfollowed, under the radar, and yet the underlying business is among the better ones that we found around. We think the investment thesis is fairly simple, and we're happy to take everyone through it. So here we've got our presentation. I'm just going to go to the first slide here. Just give a brief overview of U-Haul. U-Haul is, or Americo is the holding company that owns U-Haul. The U-Haul business accounts for 90% of the company's revenue and operating profit. That U-Haul business is split into the do-it-yourself moving equipment rental business, with those ubiquitous U-Haul trucks that you can rent to move your belongings both within cities and between cities, as well as a self-storage business. U-Haul has purchased a variety of self-storage assets that are synergistic with its moving business. In previous management commentary, they've said that approximately 25% of their movers typically will store goods in self-storage, and so it's a very synergistic business between the two of them. We weren't able to confirm the 25% number, right? The 25% of the movers do self-storage.
No, I think that's a number I heard somewhere.
Yeah. So basically, 90% plus of the business is the U-Haul moving and self-storage business. A small 7% of revenue is an insurance subsidiary. That's not very material to the overall thesis. In our valuation, we simply value it at book. On the next slide, we're going to go through the 5 investment highlights that we've pointed out here. First, and one of the most important points about U-Haul is, for those of you that live in the United States, you've probably seen their trucks, maybe rented a U-Haul van for a move. Many of you, we assume, probably can't think of the competitors. U-Haul, as we believe, is an unassailable competitive position, has 8 times as many hubs as its nearest competitor, Budget. Management estimates that they control 50% of the market. Budget and Penske, their next two top national competitors, control 10% of the market each, and then there's a variety of sort of fragmented other smaller competitors. And we believe that this economies of scale that U-Haul has built over time allows it to benefit from network effects. So in our, we've done a comparable companies analysis, and we used companies like Cisco, Waste Management, other businesses that through having a large number of hubs or distribution points have been able to develop a low-cost economies of scale cost advantage over competitors, and over time they're able to just sort of widen that advantage because of the low-cost nature of their business. In one of our slides here, we'll talk about how Budget's equipment rental, truck rental business has been struggling and how they've been retrenching it. And you can see that through the decline in their truck count over time. The second point is that it's important to note that 30% of the cash flow from U-Haul comes from their self-storage real estate. So I think the numbers are that approximately 10% of their revenue is from self-storage, but 25% of their EBIT is from self-storage. That's about right, right? And so, this company generates a quarter of its income through these high-margin self-storage business. Now, what's important here is that they own a fair amount of their own real estate, and if the U-Haul real estate was spun off in the form of a REIT, it would actually be the third largest self-storage REIT in the public markets. Now, self-storage REITs are valued at very high multiples, so that we believe that provides a floor to what this company is worth. And we come out to a number of approximately $110 per share purely for the self-storage business if it was spun off as a REIT. Now, management has indicated that's going to happen, but it does act as a floor in a worst-case scenario. One of the important things about U-Haul is we believe it has a strong management team. The company the Schoen family controls 55% of the company's shares. And we believe they operate this business for the long-term benefit of shareholders, given that they own such a large slug. Joe Schoen has been the CEO since 1986, and we believe that the executive team here sort of lives and breathes the equipment rental and self-storage business. And over time, they've taken measures that have widened their moat relative to their competitors. Capital allocation policy at this business is relatively shareholder friendly. They paid special dividends late last year as well as in fiscal year 2011. Since 2009, they've paid down $300 million of debt and preferreds. In the past, they've repurchased shares. We wouldn't be surprised if they repurchase shares going forward. Because the company has a somewhat of a low float, it's possible they do more special dividends than repurchase shares, over time. But and then the final point on capital allocation is U-Haul is just not a business. This management team is not a management team that does large value-destructive acquisitions. They acquire small self-storage businesses here and there, but we think it's highly unlikely that U-Haul will ever come out and announce a acquisition that is 20-30% of their enterprise value, because that's just not the way they operate. The cash flow that this business generates, they're either returning to shareholders or they're reinvesting in their business, whether it's to expand their footprint or to take measures to increase their market share at the expense of competitors. Last but not least, the reason we're in the stock is because of the low valuation. We believe it's a superior business, an easy to understand company, and yet it's trading for 11 times price to earnings, 5 times EBITDA, approximately 11 times EBITDA less CapEx. Regardless of what valuation measure you use, this company is trading at a discount to the overall market. Currently, the S&P trades at 15 times. We believe that this is a superior business relative to most companies out there, and our valuation range for this business is more in the 16 to 18 times PE ratio. That implies that this is a $200 plus stock. And I think sometimes when people look at the stock chart, they look at how the stock's gone up from 100 to 140 bucks over the past 3 to 6 months. But that just sort of goes to show how undervalued it was originally. We think that there continues to be good runway, and our justification is very simple. Business is trading 11 times PE. We see no reason why this company isn't going to grow its earnings substantially over the next year, over the next 2 years, 5, 10, 15, 20 years, and yet it's trading at a large discount to the market. We think a more appropriate valuation, 16 to 18 times, which gets us at least 40% upside on the stock. Our next slide is the cap structure and some of the valuation multiples. We'll move on to the U-Haul business. So we're going to go through each of their 3 segments. Their first segment is the U-Haul do-it-yourself equipment rental business. One of the important things about U-Haul is the founder of U-Haul, Leonard Schoen, essentially created this industry. After World War II, he came back and saw there was no national company that provided moves between cities. There were companies that provided truck rental and equipment rental for within cities, but if you wanted to move from New York to Chicago, there was no company out there that allowed you to rent a truck for that trip. And so Leonard Schoen began building out the U-Haul business, and to this day, he uses a franchisee model where it essentially approaches, say, parking lots or other owners of lots, and will essentially sign them up as franchisees and provide the capital, the trucks, and the equipment, and essentially allow those franchisees to use space that otherwise would be unused to generate some franchisee revenue off of the U-Haul business. And over time, he's built such a large network that it's 8 times has 8 times as many hubs as its nearest competitor. Because this is a commoditized service, the low-cost economy of scale nature of this business is very important. And essentially, we believe that U-Haul, especially over the past 10 years, where it's been able to benefit from increased IT infrastructure and increased data about who's renting trucks, where are the trucks located. It's able to optimize its both pricing on its truck rentals as well as its utilization to basically see what Budget and Penske are charging for their customers and beat them slightly on cost, but still at a large enough, high enough price that it's able to generate attractive margins. And what you've seen is the margins from that U-Haul business have been expanding over time, particularly since the recession. On our next slide, one thing to put this in perspective, U-Haul is about 17,000 locations, more than all the Starbucks locations in North America, and that just points to its large distribution network. This is a slide that shows the market share. As we mentioned before, U-Haul is 50% of the market, but Budget and Penske are approximately 10% each. And this is an important slide. So it's great to see when your closest competitors retrenching. We've laid out here the truck count for U-Haul and Budget over the past 10 years, and what you've seen is that U-Haul's truck count has increased approximately 10% annually, whereas Budget's truck count has gone from 35,000 trucks in 2001 to 26,000 in 2011. And you're particularly seeing a retrenchment since the recession. Separately, in conference calls, Budget has announced restructuring measures and has announced difficulty within that truck rental business. To quote, "We're facing a tough competitive environment in truck rental, some softness in commercial and consumer demand. We've been repositioning our truck rental business to right-size it for the demand we anticipate." What we believe is happening is Budget is retrenching around its most profitable markets, essentially leaving its lower margin routes to U-Haul, where U-Haul is essentially getting somewhat of a monopolistic competitive position as its main competitors moving out of those less profitable routes. We've also laid out the locations and network. We see a steady increase for U-Haul and a decline over time for Budget, and you can also just sort of see in the overall revenue for the truck rental business for U-Haul vis-a-vis budget. And one thing to realize with both budget and Penske is that whereas for U-Haul, the equipment truck rental business is, their main, their main line of business. For budget, it comprises less than 10% of revenue. So, it's just not as much of a priority for the competitors. We've got another slide here that shows U-Haul's competitive fleet advantage, locations, and revenue per truck relative to budget. And here we've got the U-Haul do-it-yourself moving businesses financials. What we can see here is revenue has been steadily increasing. There was a slight dip in the recession, but to some degree, this is a recession-resistant business. People are still moving during that time. And what we saw was just a revenue decline from 1.7 billion to just slightly down to 1.69 billion. And since then, we've seen a steady increase in revenue. And then in terms of the EBIT margin, what's important to note here is the increase in margins over time. And we believe that, again, this is due to a variety of factors. It's due to the increased the enhanced IT infrastructure for U-Haul and its ability to better track, its truck count, its utilization, and optimize that utilization and pricing to increase margins. Second, we believe that the retrenchment of competitors have allowed it to expand its margins. And we believe that this sort of 15% EBIT margin that we're seeing is an appropriate go-forward normalized margin for this business. We don't believe it's over-earning. I really haven't seen any indication for why this business would be over-earning now relative to 2, 5, 10 years from now, given the nature of the competitive landscape. From an EBITDA perspective, we're also increasing in expansion in EBITDA margins. And, this is partly why, a premium valuation relative to maybe what this company had traded in the past is warranted. We believe that earnings power and the margins of the business have expanded over time as it's, increasingly dominating its competitive landscape. One thing that we haven't mentioned about U-Haul is U-Haul's done an excellent job of providing ancillary services to its customers. For any of you that have rented U-Haul trucks, you'll know that they also provide boxes, packing tape, moving supplies at their U-Haul centers. They also allow you to hire someone to help you move. They have small businesses such as collegeboxes.com, which basically is geared towards college students that are looking to store their belongings during the summers during college. They've introduced a new U-Pod business to basically compete with the emerging pods sector, where if you want to move, say, from California to New York, you can put all your belongings in a pod, and that pod's transferred to New York. U-Haul is trying to prevent beginning to compete in that business so that it doesn't lose market share within the whole overall moving space to the pods sector. So that's the U-Haul business. We'll move next on to the self-storage real estate part of U-Haul. It's been buying land since the 1970s. It began acquiring real estate, sort of more than 40 years ago, and that's allowed us to build, benefit from some premier locations in many major urban centers. For instance, we visited the U-Haul location in Chelsea, and for any of you that have visited that location, you can just sort of see that's prime real estate for U-Haul. And one of the competitors that has indicated that they might enter the truck rental business is Enterprise. And when we look at new competitors, discuss potentially entering this market, we question how are they going to be able to attain some of the very attractive real estate that U-Haul has built over the years, has acquired over the years. When you're looking at it from a customer's perspective, what's important to customers is truck availability. U-Haul has a lot more trucks than any of its competitors, as well as the location. With 8 times as many hubs, let's say you're moving from point A to point B, you're much likelier to go to a U-Haul hub, rent your truck, because when you're dropping it off, you're not going to want to go out of the way to try to find an out-of-the-way hub that Budget, Penske, or Enterprise might have. And so the locations that U-Haul has acquired over the years are definitely a competitive advantage. as discussed before, many do-it-yourself movers need a temporary storage solution, and so therefore, the self-storage real estate that U-Haul owns is more synergistic with its operations, more valuable to U-Haul than many of the self-storage operations that are owned by REITs that don't necessarily have this equipment rental business that's driving revenue to their self-storage assets. What we can see is revenue over time from the self-storage business has been increasing, as has its EBIT. As we can see here, the revenue contribution, between the three different segments as well as the EBIT contribution. And then here we've got a comparable companies analysis where we look at the comps, what the comps are valued at. Now, what's great about the self-storage business is that it has low maintenance cost, low operating cost, and low economic risk. And there's also substantial optionality with certain of this real estate. To the extent that you see that real estate increasing value, U-Haul and other self-storage REITs can sell off that real estate to another developer that can use it for commercial real estate purposes or residential, and generate capital gains off of sort of upselling that real estate for a higher value-added use. And so therefore, with a lot of the comps, we see them trading at high multiples. From an LTM basis, or probably maybe like TEV to EBITDA forward 1 year basis, you're seeing an average median multiple for the REITs at 20 times. And if we value the U-Haul business at 12 times, we get $90 a share for a business that's generating only 25% of U-Haul's EBIT contribution. If we use a 16 times multiple, which is still 4 turns lower than what the comps are being trading at, you get to $120 per share. So again, management's indicated that they're not going to spin off these assets into a REIT, but nevertheless, it provides a floor value to what this business is worth in our opinion. Last but not least, we'll talk about the insurance business. This is a small part of U-Haul's overall operations. There's 2 insurance operations. There's RetWest, which is focused on insuring U-Haul truck rentals. It's had some missteps over the past, and therefore management's indicated a desire to keep that business focused on just U-Haul truck rentals. For instance, this poor underwriting came in a non-core line involving workman's compensation. And then there's an Oxford life insurance business. Again, this is just a small part of the overall U-Haul story. We don't think it's that material, as long as management's avoiding mistakes, which they've indicated, that they're going to be very careful going forward to, prevent, unforeseen events within that insurance business. We don't believe it's a very material part of the story. We value that business at book on our sum of the parts analysis. And then finally, we'll just mention again the value of the management team here. It's good to be investing alongside a management team that knows this business inside and out, that has an established track record of increasing market share over time, increasing the number of ancillary businesses that U-Haul has provided over time, and that owns 55% of the company's shares and acts in the interest of shareholders, and therefore has taken some of the shareholder-friendly capital allocation actions over the past 5 to 10 years that sometimes you don't see with other companies. This is an overall financial summary for the business. Again, just point to the low valuation, 11 times PE. Our argument's fairly simple. This is a great business. Instead of trading at 11 times PE, it should be trading at 16 times PE. What does that mean for the stock price? It's probably worth more than $200 a share fundamentally. That implies 40% upside. And then last but not least, we have an illustrative sum of the parts analysis where we take the U-Haul business, tack on a 9 times EBIT multiple, and take the real estate business, tack on a 12.5 times EBIT multiple. Again, remember the comps are trading at 20 times, and although it's not apples to apples because this real estate isn't paying a dividend to shareholders and therefore isn't trading on a dividend yield, this 12.5 times multiple we think is a reasonable multiple to apply to the real estate business. And then we just sort of use a 9 times multiple for corporate, and then value insurance at book. We get to $200 a share again. So again, 40% upside from current levels. And so, that's our overall U-Haul thesis. Navi, is there anything else that you think we should mention?
No, I think another key point is just to emphasize the fact that budget is retrenching rapidly. And you'll notice back in the prior chart, you'll see the revenue per truck for budget has been declining, and that reduces their ability to compete on a cost basis. If they're only making 4 or 5 rentals per truck and U-Haul's making 8 or 9, U-Haul can keep earning either a fatter margin on that rental or cut their prices and undercut budget. So, so far we're keeping a very keen eye on the competitive dynamic, and we're seeing every piece of evidence that that advantage is widening over time.
So I'm going to turn the volume up.
Yeah, thank you, Sahm, for those remarks. We're going to open it up for the Q&A session now, so if you do have a question, feel free to type it into the online interface. Maybe I'll just start it off with one question, Sahm, in terms of the growth prospects for this business. It looks like it's been sort of a low single-digit grower on a number of metrics over the past 10 years or so. What do you think growth looks going forward? And then related to that, if there isn't going to be a ton of growth in which to reinvest, how do you see capital allocation going forward?
Sure, I'll answer it, and then I'll turn it over to Navi to get his insights. So management does not provide guidance here. In fact, one of the reasons we believe that this company is trading at a low valuation is because there's no sell-side coverage at all. I think CL King, may cover them, but no real investment banks are covering this company. The company doesn't provide forward guidance. And, it's not a management team that's out there, going to every conference trying to promote their business, because they own 55% of shares. They feel that as long as they're continuing to build value in this business, and generating cash, they'll just pay it out to themselves in special dividends, and public shareholders can come along for the ride. So we don't get guidance. To your point, they operate in a mature sector. So the overall United States moving sector is not expanding that much ahead of GDP. And so, where growth is coming from this business is through margin improvement as its competitors retrench, and increased pricing and utilization abilities. And so, you're not going to see a tremendous amount of growth in this business, and it's difficult to go back over the past couple of years and determine what of their sort of healthy revenue growth has come from sort of the market just bouncing back from the recession, and what is more sort of normalized growth. But mid-single digits might be appropriate, but I think still at 11 times PE for a business that has pricing power, as U-Haul does, it's just too low of a multiple, given that this company is going to be larger 5, 10, 15, 20 years from now. Now, it's not a tech stock. It's not going to be tremendously larger, but we think that we'd be surprised if 10 years from now this company is not worth 13, 14 times PE at that point. We think its growth prospects are going to continue to be healthy going forward, and so you're going to get a little bit of multiple expansion. You're going to get decent growth on the top line, and I think that justifies the price. But to your point, you're right. It's not a rapidly growing sector because the overall U.S. moving business is somewhat slow growth. And thus far, management has not expanded beyond the U.S. and Canada. We were talking internally of whether why a company like this wouldn't try to expand into Mexico, or just take sort of their basic business model, just expand it internationally. I guess this management team isn't as aggressive as some other management teams about that type of growth.
Yeah, I think one point I would also mention, being a multiple-time customer, they've started. You have to remember their market share is 50% within the idea of doing it yourself. But as a total of all moves in the United States, most people generally tend to hire a mover. And one possible window for them, they've started really pushing hard on this idea of you renting your truck through U-Haul, but then hiring an outside mover through them through a referral system. And that prevents you from having moving fraud, because you own your own assets, you hold your own assets in your own truck. And that could possibly open up 70 or 80% of the market, basically doubling their potential addressable market in terms of who they can help. And also, over the last year, yes, the overall moving industry may have only moved 1 or 2%, their earnings have been growing 15% compound, and I think they'll do it again this year. Because as they deploy each truck, it's like poker. You have a bigger stack, and your competitor has a smaller one. You just keep pushing on them, and we think there's still more room for them to take market share from Budget, Ryder, and Penske. So.
And then, Sam, you alluded to the potential for the real estate business to get spun off or something to happen there. Could you just fill us in on what you expect on that front?
Yeah, so, management has not indicated that they're interested in doing that. We don't expect it to actually happen. It's more from a floor valuation. I mean, we think that if they did, this stock price could be up at least 50%, like just on that news, because of the fact that the multiples that those self-storage real estate assets or businesses, REITs, trade at relative to where U-Haul's real estate is being valued. Unfortunately, we just don't really see it as an upside that's any more than theoretical, because management owns 55% of the shares. You're not going to see an activist come in and try to get them to spin that asset off, and for the time being, just don't really think it's actually going to happen.
We have a question from Brian Olson on the competitive dynamics a little bit. He says, could you put some perspective on the pod business as a potential disruptive force? He's referring to that growing trend to use small containers called pods to transport personal goods during a move.
Sure.
Yeah, I think the pod business is an interesting concept, but it still relies on a physical distribution infrastructure. And that physical distribution infrastructure, U-Haul's a $3 billion company and already has 17,000 hubs. And I still don't think with that many sales points and that much of an infrastructure advantage that anybody can really compete with them. U-Haul's, to credit to this company, they saw that potential disruptive method of moving and quickly said, fine, we're going to offer it to. And that's that. They saw the car rental business, somebody, rather than renting a truck for 5 hours, maybe, having a car and moving a few things like a student, they quickly just said, fine, we'll rent out some cars. And so anything they see as being a potential disruptor, they tend to cut it off at the head. So if you use U-Haul's pod moving system, it's definitely better than if you go to pods.com, in my opinion. I've checked out both. When I was moving, I was considering it, but I was moving a short distance, so it didn't make any sense. But I think U-Haul already has a better service. It's a very easy thing to copy, and they have a larger infrastructure anyway. So.
Michael Knipp writes, thanks for the great presentation. I'm surprised to see that the company did not lose money during the recession. Can you talk a little bit about the balance sheet and usage of debt?
Sure. Yeah, I mean, it's tended to be a pretty recession-resistant business. That might have been because of the competitive positioning of the company. That might have been just because, because they were the sort of the main go-to firm for moving and equipment rental during the recession, and therefore they continue to have some pricing power. You did see a dip in their EBIT. If we go to their overall earnings power, you saw their EBIT margin slip. The overall revenue didn't decline that much, but I think what they did is I think they reduced their truck count, right?
Yeah.
There's increased utilization, so utilization went down. So you saw a decrease in their overall margins, but then they right-sized their fleet and margins bounced back nicely after the recession.
Yeah, just give some color. Their total transaction volume, I think, moved like less than 3%. In terms of the actual number of people in the United States that had to move at any given time, recession, no recession, doesn't really change much. You'll have people that are in a big house maybe move to a smaller house, but you still end up moving. What happened was, as the housing boom was going on, people are moving, things are great. U-Haul went out and bought a lot of trucks, so their truck fleet was expanding. What happened with this recession is the decline in pricing was more rapid than anybody had ever suspected. So their truck fleet just, wasn't earning the revenue they expected. So it took a couple of years to shrink that truck fleet by 5,000 or 6,000, get their DNA and everything down to a normalized level. Of course, their EBITDA obviously stayed positive. They'll never really lose money. It's all DNA effectively that went through the balance sheet and some of the interest on buying those trucks. But they right-sized their fleet, and then you have a lower truck fleet, and off you go. Hertz, exact same thing happened with Hertz. These types of businesses don't really lose money once they're dominant. And now coming, the new market, they're spending a lot of money to get their truck fleet back up to where they were planning to have it a few years ago.
Simon Dennison Smith from London writes, it looks like they spend almost all of their EBITDA on CapEx each year. Is that correct? And then do you have a feeling for what their maintenance CapEx would be if they stopped investing for growth?
Sure. So when you're looking at capital expenditures for this company, you have to net out proceeds from truck sales. So trucking companies across the board, they purchase new trucks and then they resell their old trucks on the secondary market. And so, whenever you're looking at CapEx at any of these companies, whether it's U-Haul or full truckload or less than truckload companies, you're looking at a net CapEx number. And when you look at it from a net CapEx standpoint, the company generates, cash flow from operations that is significantly above its net CapEx. I believe the numbers are, in this past year was like $700 million operating cash flow and like 300 to 400 million net capex, 300 million net capex.
Yeah, this year they'll do about $380 million in net capex. As a rule of thumb, what I would do, just to simplify, because there's a lot of moving parts, the change in their truck fleet, like how many trucks they add, multiply that by about on average about 25 grand. That'll tell you what their growth capex was. So of the 380 million they spend this year, I think they're going to add about 5,000 trucks or whatever. So it'll be about 100 to 125 million of that is growth capex. And about 250 million, give or take, will be your maintenance capex, just to kind of keep the fleet steady. I think there's about 106,000. We estimate they'll be close to 110, give or take, when they announce their truck fleet March 31st. So they don't disclose their truck fleet until the annual because they don't want the competitors to know how many trucks they got out there.
Adam Zerker has a question on the small life insurance business that the company has. Do you see that becoming a bigger contributor to EPS over time? Is there any growth potential there, and a little bit on the niche that business is serving?
Yeah, no, we don't think it's that material. The growth in that business is sort of small and steady. They've added a bit to it, but not that much.
It's a legacy, business from back when their dad was running it back in the day. They like the team, that they're doing a good job, they're not screwing anything up. And I think eventually it makes a lot of sense for those guys to go ahead and be acquired by another large insurance company. There's a lot of synergies, but this is like a group of people they've known for a long time, so they don't want to have like everybody get fired or whatever. I think they're going to give them a little more capital. In the last quarter, they announced they're going to give them another, I think it was $85 million or $90 million of capital to put to work. So their entire book value is like $250 million. It's not a material number. It won't be a big driver for this company.
George Canis says that a number of years ago the company had some family strife which caused the shares to plunge. Are any of these issues any longer material?
No, we don't think they are. So basically, U-Haul has a very interesting background. Leonard Schoen originally founded the company in the 1940s. He ended up having 3 wives and 7 children, or 12 children?
Yes, 5 wives and 13 children.
5 wives and 13 children. So that ended up causing some succession issues for the business. Originally, in the 70s and 80s, he groomed his oldest son, Sahm Schoen, to take over the business. And Sahm Schoen came in and, along with his dad, they tried to expand the U-Haul business into other types of rental products. So they began renting skis, other consumer goods, and yet they didn't have the economies of scale to benefit from those businesses, and just that expansion didn't work. And what you saw during that time was Ryder Truck Rental. It was a public company at that point. It began expanding aggressively into U-Haul space, and it got to the point it was able to generate enough market share where it had as many trucks as U-Haul did. And so Sam's brothers, Joe Schoen and Mark Schoen, Joe is a Harvard MBA, came in and basically criticized what his father and what Sam Schoen were doing, and essentially engineered a boardroom coup where they took over the business. And there was one instance in the 1980s where, in order to maintain control, they engaged in a certain sort of equity issuance to to shareholders that were friendly with Joe and Mark. That resulted in the father and Sam Schoen then suing them for sort of an illegal share issuance. In the late 90s, that lawsuit was settled. U-Haul basically paid out $400 million to the father and to Sam Schoen, essentially bought them out, and now they're not shareholders anymore. They're not part of the picture, and the family that owns the U-Haul shares are Joe, Mark, and other family members that are aligned with their strategic focus. And this is the right management team. Basically, Joe and Mark came in and withdrew from some of those ancillary rental products, refocused back on the equipment rental and the self-storage business, and since 1986 have emerged victorious within that battle between within the marketplace between them and Ryder. And Ryder was ultimately purchased by Budget Truck Rental in the late 90s, and what we've seen is over the past decade, that business has struggled mightily against U-Haul. And so, it's an interesting story from a background perspective. What we haven't mentioned is what happened in 2002. The company suffered a technical default due to certain related party transactions that were going on between the business and self-storage assets that were actually owned by Mark Schoen. Now we can correct me if I'm wrong, but basically the company didn't have an equity interest in those self-storage assets. But after the Enron scandal, the SEC changed rules, or I don't know if it's SEC or the IFRS changed the accounting rules such that those assets had to be consolidated onto the company's balance sheet. When that occurred, they ended up tripping covenants on their debt, and so their debt became payable immediately, and the company had to file for bankruptcy to protect itself from creditors. But equity wasn't impaired. They simply refinanced that debt. This is a function of 2003. There being tight credit markets. They refinanced that debt, paid off creditors. Equity sort of declined substantially, but then just bounced back up. And again, just don't think it's that material to what's going on today. Those Mark Schoen assets and the related party transactions that are going on between the company have been scaled back over the past 10 years as Mark Schoen has basically repaid its note that is due.
That's right. There's like $175 million left. That's in our valuation table. Yeah.
So just don't think it's that material, today.
Yep. And then Adam also is asking a little bit about position sizing. Maybe you could just address it in terms of, when you have a company with this type of thesis and a solid business like this, how do you kind of think about position size?
Sure. I think today U-Haul is an 8% position for us on the long side. So we've been pretty aggressive about our U-Haul position. We think it's cheap relative to other stocks in this market, the other stocks that we have in the book that we're looking at. And you just don't really see a lot that can go wrong with this business. Again, the real estate provides a floor value. They're the dominant player in their market. You're not seeing a tremendous amount of growth, but again, there's limited downside for this stock. And so we've built this into a fairly sizable position. We just don't view this as one of our speculative investments. Rather, this is a company that, we can just sort of sit on that stock for multiple years and, sleep well at night. That's just the type of business it is. It isn't a one customer type of business. It doesn't really have emerging competitors. I think it's a pretty safe story. You're not going to get rich off U-Haul. Stock's not going to double overnight. But we think, we come out to 16 times P. It's worth 200. Today's trading at 140. There's a nice margin of safety there. And given the type of business it is, we justify making it currently our second largest position and currently 8% of the book.
Yeah, and I think if they start paying out a regular dividend, I think that would be a massive catalyst to the stock. Because then your average REIT owner, if you're Vornado Trust or whatever, you're going to get a far cheaper way of buying into real estate through U-Haul than you would buying into the public storage REITs, which on average trade for 20 to 25 times forward earnings.
That's interesting that they don't pay a dividend yet, especially also given the family interests and that they might want to take some cash out regularly as well.
I think they've been waiting to get their balance sheet like completely liquid, and right now they are just flush with cash. They got more money than they know what to do with. That's why they paid the $5 special dividend in December last year. I don't think it was a tax thing. It was just a continuation of the dividend they did the year before. Just prior to this recession, they were buying back stock pretty aggressively. So we would expect that type of activity is probably, you're going to see probably something similar to that again this year.
Okay. I have one more question, and then I'll go to Oliver for a question or two. Luis Ahumada writes regarding the possible over-earning, how do you know that their main driver of the currently high margins aren't cyclical drivers rather than growing market share with higher utilization? What evidence is there that improved ROA are structural and not a cyclical peak? And what is a fair ROIC over a full cycle?
Okay, so the questions are, is the company over-earning given its high margins? And what's a fair ROIC over the company's horizon? On the return on ROIC, I think it's been approximately 20%, right? So it's been approximately 20% during normalized environments. We think that's going forward. Why don't I hand it over to you in terms of
I don't think this is your typical cyclical business. It happened to be in a situation where they had too many trucks walking into this recession, but it's not the typical. Remember, the transaction volume, the number of moves in the United States does not really have a cyclical effect. With respect to the margins, be careful with historical comparisons because a few things have changed in the accounting. They've shifted from leasing trucks to owning them. So you may notice, for example, their lease expense has fallen off over time, despite the fact they've grown their truck fleet, and interest rates have gone, the interest expense has gone up. So they're buying more trucks. So that's going to obviously lead to a higher EBITDA margin or EBIT margin as well. They're owning more of their stores, as we mentioned before. The 17,000 locations they have. Every truck rental that you do at Bob's truck stop / U-Haul location, Bob gets a 20% commission for that truck rental. If U-Haul opens up a truck hub in that area, A, they just turn way more volume through their own stores, and B, they don't have to pay commission on it. So there's a lot of structural factors that are leading to the growth in the EBIT margins. Even if you said to yourself, well, I'm worried about EBIT margin falling down, and we've kind of done some sensitivity and said, all right, what if utilization falls, whatever, we still get to a very, very large amount of profit. I don't think you'll see this business lose money again. Unless, again, you could have a 1 or 2 year situation, the next major recession, 2020 or whatever, you may have a 1 or 2 year situation where, the profits come down a little bit. But broadly speaking, I don't think it's a typical cyclical business.
Oliver, I'll go to you now for 1 or 2 questions.
Yes, Sahm and Navi, thank you so much for a great presentation and that very helpful slide on the revenue per truck. I noticed also that not just Budget's revenue per truck has come down, but U-Haul's has gone up. And what are some of the drivers there in terms of breaking it up between just the kind of basic rental and then all the ancillary things that U-Haul's doing?
Sure. So a couple of things to note about revenue per truck. As U-Haul is increasing its footprint and moving to, into routes that aren't as core as, say, Chicago to New York or this or that, it's incrementally making money and generating attractive return on capital. But its revenue per truck is not necessarily going to be as high as some of its most profitable routes. And so I think that's one of the reasons you've seen their revenue per truck be somewhat consistent over time, as opposed to be increasing. It's just because of the expansion of that footprint. Now, offsetting that adverse factor is just the fact that over time, you're seeing when you see Budget retrench, that's resulting in them having a higher cost, infrastructure and cost structure are higher fixed costs, and therefore budgets being pressured to increase their pricing, and therefore U-Haul can increase its pricing relative to them. And again, I wouldn't, with a lot of these trucking companies, I wouldn't downplay the technological transformation that these businesses have experienced over the past 5 to 10 years. I follow the full truckload sector relatively closely, and companies like Swift and Werner have really benefited from having just more data on their routes, fuel usage, utilization, etc. And that allows them to sort of increase pricing and utilization to maximize such factors as revenue per truck. And have the right amount of trucks in each location, and just really right-size that fleet for the customer bases around certain hubs. That allows them to keep their revenue per truck relatively steady.
Yeah, I have nothing else to add.
And then I was also wondering, in terms of the age fleet, what's the life on these trucks, and how does the age fleet look like?
That's a good question.
Yeah, so management doesn't disclose age fleet, and they said that it's no longer a relevant metric for what they're doing because of the way that they've started expanding their truck fleet out very, very broadly. The average age of a U-Haul truck is about 15 years, and they tend to keep that truck close to the end of its life because those trucks are customized. So if you notice when you're on the street, you'll see Ryder Penske trucks. They tend to have a very high back because they're very catered towards commercial trucking. They're not customized for your average mom or dad who wants to move some things. U-Haul will lower their truck base and make it very easy for you to move into it. So their trucks tend to not have much of a use after their 15-year cycle. Sometimes they'll sell them off to commercial users. The main cycling that happens is in their vans and their pickup trucks. So the vans and pickup trucks obviously have a huge secondhand market, and those will tend to cycle every, I think, they indicated 2 to 3 years. So they'll have a truck for 2 to 3 years and then they cycle it out. So you're not going to have an iPod dock in your U-Haul moving truck until probably 2025.
Great. Well, thank you again, gentlemen, and I want to turn it back to John.
Yeah, thanks, Oliver. Maybe just as we finish up, one last question. It's a little bit not on this company, but I was wondering if you guys had maybe looked at a company called Sixt in Germany. It's like a moving company and car rental or truck and car rental company in Germany. It's about 7 times earnings and close to book value. And
no, we haven't, but we'll take a look. It's SIXT?
Yeah, it's ticker SIX, the number 3 in Germany. Okay. And having lived in Germany, their trucks are everywhere and they have big market share there. So, could be a comparable to this company, but I do know that Sixt is very much focused on Germany.
Right. Yeah. No, that's interesting. I mean, this business, if you can be sort of the market leader within this sector and really develop an infrastructure that dwarfs your competitors, there's a lot of pricing power. And so, Sixt has done that in Germany. That would be interesting. We'd definitely take a look. I think where you get into trouble with these sort of sectors is if you've got a couple of guys that are competing with one another at the top, then you can become a more commoditized business. If one company doesn't have a significant cost advantage over another, but to the extent any other business, abroad or any other country has developed sort of a U-Haul type position, yeah, we would definitely take a look, especially if it's at 7 times earnings.
Well, with that, guys, thank you so much for sharing your insights and for really coming on to address our global audience and present your thesis.
Great. Thanks for having us. It's a pleasure.